Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Craig Martin. Craig is a certified financial planner, has his company, the Family Wealth Consulting Group. He's a fee-only financial planner, and he's been providing asset management services for some 30 years.
Mostly.
Oh my gosh.
Ages us both, Mike.
Must be somebody else. And I've known Craig for almost that long. So anyway, so Craig, welcome to the show.
Good. Glad to be back.
Thank you for being
You have a
with me.
memorable show here. You are recording some of the best information available from professionals in this valley. So
Yeah, thank you very much for that. Yeah, it's my pleasure, and I'm kind of excited about it. I've enjoyed doing this. So today, Craig and I are going to be talking about making sure your retirement portfolio outlives you. And so as we're getting into retirement years, more and more of us baby boomers, are getting up there. We're going to have a huge bulge in our population here coming up. And unfortunately, I'm afraid a lot of people aren't going to be prepared, but we'll talk about that.
yeah, the news this morning, Mike, if I remember the numbers correctly, said that 10,000 baby boomers a day will be turning 65.
Isn't that amazing?
But not all of them will be retiring.
I guess not. Well, especially after the last few years, a lot of people have made investment mistakes and so forth, as you and I know, and with what's happened with the markets and so forth, the inside joke is that it's not a 401k, it's a 201k.
Yeah,
right?
That's been popularized.
Okay. All right, well, let's get started with the lead-in question. Why should I care about whether I outlive my retirement portfolio? Won't Social Security cover my retirement? When I retire, how will I know how much I can spend from my portfolio and not outlive it? That's a lot of stuff, but why don't we get started a little bit along that line?
Good. You don't want to outlive your retirement income. Number one fear of all retirees is outliving their income.
Mm-hmm.
It doesn't matter whether you have $10 million or $10,000 in your investment portfolio.
Mm-hmm.
Survey after survey says the same thing. I don't want to be a burden to my kids or to the family or to other people. So I don't want to outlive my income. And yes, a good part of the retiring public will be depending upon Social Security as their major source of income or sole source of income, which is sad. And if you're going to retire this year, we've just been through a huge recession. So understanding where you're at in your retirement portfolio and how it's allocated between stocks, bonds, cash, and others is a critical decision. We'll talk about that
Yes.
as we go on today.
Right. But the point is that Social Security was never really intended to provide for all of your retirement needs. It was sort of a safety net. And people who are retired don't have much else. Are glad that it's there. But anyway, it doesn't provide a very comfortable retirement, really, does it?
Yeah, the Social Security established age 65 as the retirement age. It was almost an arbitrary number created back in the 19th century by some German political person. I don't know his name.
Bismarck, maybe. I don't know. Who knows?
And to imagine 65 as the retirement age today is a bit unrealistic given our life expectancy. But it has been accepted as the popular age. It's what everybody says is their retirement age. But what we're going to discover in this decade and the next decade is that it probably won't be the popular retirement, the actual retirement age.
Well, I think what some people will find is that they may decide to start another career or something maybe after that point. Well, see, I saw stuff in the newspaper today. I mean, fire chiefs retiring at like 57, and they're getting these wonderful I'm so jealous. But anyway, it's I remember when I was a little kid, and I said, when I grow up, I'm going to be a policeman. And then I was sort of discouraged along that, I might have been better off as a policeman. Well, anyway, that's, of course, then they shoot at you. So there are pluses and minuses there. All right, well, we should move on because we've got a lot to cover here. So how will I know when I have the right distribution amount?
You won't.
Oh, okay.
What we can do is use historical evidence.
Uh-huh.
We can use current research on how to build risk-managed portfolios. And we can build portfolios which have a high expectation of returns and expected payouts. Mm-hmm. So what we're going to discover today is how to build a risk-managed portfolio and why having that risk-managed portfolio is so important, and how it will maximize both the amount of dollars that you have in your portfolio as well as the amount that you can spend from that portfolio and still be able to outlive your income.
Okay.
Excuse me, to have your income not outlive you.
Okay. I guess what it boils down to is that we need to retain some sort of a principal amount.
Yes.
To continue to have invested. And so if we draw too quickly out of that, then it's just not going to happen. It's just not going to be realistic. So you have to balance what your living needs are with your expectation of being able to generate a continuing source of funds.
Yes.
Yeah. Okay. So here's a good one. What portion of the U.S. population is in financial distress during their retirement years?
Wow. Just this morning, I think I saw the statistic that 10,000 baby boomers are going to start retiring January 1st.
Right.
Or that is, reach age 65 on January 1st. And it was just last week, I think, that I saw 40% of the investing public doesn't think they can afford to invest because of the Great Recession of just a couple years ago.
So they can't afford to invest? So
did I say that?
Yeah.
Can't afford to retire.
Oh, can't afford to retire.
Excuse me.
Okay. Yeah, that makes sense. Okay, so why is this situation likely to get worse?
Well, we've just been through the greatest recession in our lifetimes, probably, and what it did was scare the majority of the investors out of the equity stock market and into banks, bonds, and bills. Mm-hmm. And what that caused was, what that means for those investors that have left the stock market is that they cannot participate in the recovery. Mm-hmm. And they have not most have not participated in the most recent recovery. Mm-hmm. So the chances of them, since the market went down close to 50%, most people's accounts went down that much.
Right.
And because they're in the banks, bonds, and bills today, they're not going to recover due to the market movement. Mm-hmm. So they are going to struggle making their retirement goals. Mm-hmm. Mm-hmm. And it's real sad that the investing public has done that.
Okay. So I guess one thing I want to mention to people, to give you a little reference, because you're going to be seeing this program at different times, is today is December 28th, 2010. So that's when we're recording this program. All right. Craig, next question. What do you need to know as a starting point for retirement fund planning?
Well, certainly we need to know how much money is in your portfolio. We need to know how it's allocated in the market or not in the market. Mm-hmm. We need to know what it costs for you to maintain your standard of living. Mm-hmm. I normally describe that as your non-deductible expenses. Mm-hmm. So some people are living on $35,000 a year, but some people need $105,000 a year. Certainly affects what size needs to be in your retirement portfolio between those two numbers.
Right. The cost of living, it's a big variable around the country, I think. And so like here in Silicon Valley, it feels like you can't live here with under $100,000 a year. And,
yeah.
But there are other parts of the country where the cost of living is much lower.
Yes.
Okay. So, well, why not just have a savings account?
As I spoke earlier, if you're not in the stock market, you will not participate in the recovery of that stock market. And so banks, bonds, and bills traditionally pay less than 5% a year. Currently, their yields are under 2%, closer to 1%.
Yeah.
So for you to try and retire on a bank account means that you better plan to have quite a few $1,000,000 in there to eke out a bare sustenance in your income.
Yeah. So they have a commercial right now for some company, and they're saying, you know, oh, you can get 3 times the national average for your savings account, and what they're not saying is the national average may be 0.5%, and they're getting 1.5%.
Or less.
So,
Yeah.
so there you don't get much interest these days on savings accounts, and so when you start drawing on it, well, that means that there's not going to be much income to draw on, and you're going to draw on principal. And once you start doing on that, you're sort of on the death march, I guess, as far as having those retirement funds available.
Yeah. People who live on a bank account have highly volatile incomes, or bonds have highly volatile incomes because interest rates, dividend yields vary so greatly. And your description of an account that pays 3 times the national average, my explanation to clients is that if you're seeing an investment or interest rate yielding account which is twice the national average, it's probably got twice the risk. So if something's paying 3 times the national average, you better be very cautious about whether you want to invest in that or not.
So you sort of wonder, what are they investing in? I think what's happening, and those are probably credit card companies, and so they're getting, like, you know, the credit card companies are getting 18%, and then they're paying, 1.5%. They can afford to. But there is a lot of bad debt these days, as we know, a lot of bankruptcies and other things that's happening for people with their credit cards, and so there is more risk maybe than many other bank loans. All right. Why should an individual invest in marketable securities for their retirement?
Because it's the only way you can expect to beat inflation after taxes and expenses. So the stock market has returned an average of 10% over our lifetimes so far. And the expectation is that stock market will return another 10% over the rest of our lifetimes. All you have to do is buy that stock market and hold it. I call that a free return. I tell my clients you can do that without hiring any professional advisor. You can buy the stock market with an index fund. And the key to it is to hold on for a lifetime. If you hire a professional risk management expert, as we are, what we're going to be able to do is bring you the returns of the stock market with less risk than the stock market. We're going to find out how important that is in just a moment. And in many cases, we're able to outperform the stock market with the same or greater risk. So very important to have a risk-managed portfolio. And that's what we have studied. And I have a master's degree in the business so that I can help my clients build that risk-managed portfolio.
Right. But on the other hand, it's not really rocket science, is it? I mean,
well, it won a Nobel Prize, so the formula is pretty well known. And finding the right investment vehicles is the key. And so that's our expertise.
And the other thing, and we talked about this before, is it's really the emotional management is really a huge piece of this. So we talked about, like the people bailing out of the stock market, of course, when it fell. And then the other question is, well, when the heck do you get back in? And if you're scared, then chances are you're not going to get back in soon enough.
The investing public has not moved back in. A record amount of dollars left the market during the Great Recession. Slightly at the end of the Great Recession and after the recession. In other words, they got out at the bottom.
And then they missed the 60% recovery.
That's correct. 60% recovery since then, and they have not participated in that. Most of those dollars are still sitting outside the market.